Hello again, everyone. Brad Husselberg, Market Forge owner and founder, back again with another market update from this previous week. Look, if you were watching the headlines, you felt like there was some serious volatility and that market structure was likely breaking down. But if we look at the charts, we'll see that that is really not the case. There are some things that I'm going to point out that I think are relative, but nothing to be spooked about as of yet. As of right now, this looks like a pretty normal market reaction to just some tariff headlines, some geopolitical comments. We had the World Economic Forum this week or last week, which had a whole lot of commentary, which could account for some of the volatility that we saw throughout the week. There's nothing in here from the charts that really spooks me, but there's definitely some things that we need to keep an eye on going into the following week. So we'll go ahead and just jump into it as we tend to do. Now, before we get started, just as a reminder, this is not financial advice. I am a financial advisor. If you are looking for advice on equities, bonds, or even crypto, check out the link below. It's themarketforge.com. I have a unique offer for those folks that are looking for direct advice. Check out the link below. Also, there's a PDF in there. It's called the Blueprint. This is what I use to kind of create market sentiment. This is where some of my ideology comes from and the things that I look out for. If you're curious how my brain works and you want to be able to look at some of the same things, check out the PDF below. But with that said, let's go ahead and get started. So the first thing that we're going to take a look at is the S&P 500. Obviously, this is, just an overall benchmark when we're looking at the markets. And it gives us some idea of how U.S. large cap is performing. Now, what we see here is, pretty normal price action. Yes, we had some volatility. You can see that on Tuesday we had a pretty aggressive candle to the downside. Now, if you were looking at the headlines, this came on the exact day where there was some tariff talk from Trump. As we've seen in the past, that stuff tends to fade and then markets tend to rally. That's exactly what we saw. So Tuesday, you saw the sell-off came down into this, essentially this buying zone. So market structure held up really nice, and then buyers came in and aggressively bought up that dip, which usually means that we have a relatively healthy market. You'll see that our momentum indicator down here at the bottom suggests that momentum should continue to the upside. Does that always work out that way? Of course not. But momentum is certainly still in the favor of the bulls. What you'll see here is we've got our weekly volume weighted average. We are technically below that. If this were to extend out, we did wick into that, which is definitely something to watch for as we open on Monday. But beyond that, we're above the 20, we're above the 50 moving averages, which tells us that we're still in a comfortable market structure zone. But it's certainly something to watch. We do have a lower high sitting here. That doesn't necessarily mean that we're going to sell off and it's the end of the bull market, but it's definitely something to keep an eye on as we open into next week. The next thing I wanted to take a look at, this is our equally weighted S&P. So if you remember from previous videos, your general S&P 500 is going to be more aggressively weighted towards the higher performing stocks. So they're going to hold more Nvidia, they're going to hold more of Meta, more of the Mag 7, and those are going to be a heavier weighting on the overall performance of the index. What we have here is the equally weighted, which means that every stock is equally weighted in the S&P 500 as opposed to the larger caps or the mega caps, taking up more of the weighting. So if you look here, and I'm going to show you this in the next chart we're looking at, but this actually outperformed the overall S&P 500. Now on Friday, the S&P 500 outperformed, but overall, if you look here, you had this big candle to the downside in the S&P 500. Your equally weighted didn't have that same move. Okay, this is Tuesday. It's the same day. You had a much smaller candle, and you bounced pretty aggressively off the 20-day moving average and just continued to go to the upside. You did cool off a little bit towards the end of the week, which is to be expected. I mean, you got a pretty aggressive move here to the upside over the last couple of weeks, so it's not unusual for these things to cool off. You have some profit takers, but overall looks relatively healthy. You had a new weekly VWAP that came in here, and you can see that it wicked down and just bounced right off of that. So overall looks pretty healthy. Your moving average or your momentum indicator is showing a bit of a downtrend. Nothing that I'm overly concerned about. You're not anywhere near this demand zone down here. So still looks relatively healthy, relatively bullish. The second one, third one actually, we want to take a look at. Now, this is the equally weighted S&P compared to the S&P 500, the non-equally weighted. Now, if we pull back here, first off, we see a nice aggressive trend to the upside. So when it's going up, that means that the equally weighted is outperforming the traditional S&P 500, which was what we've seen for the past several weeks. And you can literally see it here. Now, if we pull way, way back and we look at this from a much larger perspective, let's see if we can squeeze all this in there. A little tough. Last time we saw a high here was January 2023. That was quite a long time ago. And ever since then, it has underperformed the S&P 500. Then we got to early November, and it has essentially outperformed the overall S&P 500 since that time. Now, you see a trend line here. The trend line is, we want to break this trend line. If we break this trend line, that's bullish for overall breadth in the market, which means that the large mega caps are not running the market like they have been the last couple of years. It means that other stocks are getting involved, which is healthy. We want to see that in a market. We do not want to see a market being driven by just a handful of stocks. It's like a chair with two legs, right? It just really struggles to stand up on its own. But here you're getting real expansion. So if this can essentially bounce off these moving averages and then continue higher and break out of this trend, that is very bullish for the overall market, showing you that other equities are getting into play outside of the Mag 7. Those are important things to see. But if it rejects here and continues lower, that's not a particularly good sign. It does feel like we're on the edge of something, and we're just waiting to see if this is gonna continue to move to the upside, or if maybe we're gonna get a breakdown here. Everything would suggest that we're continuing to the upside. S&P 600. So these are the small caps. We've been watching this for the last couple of weeks. It's been a really good indicator of where we're sitting overall. Like we've been saying for the last couple of weeks, breadth feels like it's returning to the markets. Other indexes are performing well, and the tech stocks and the mega cap stocks have been underperforming. Which is fine. They've been aggressive for years now. It's okay for them to pull back and take a little breath here. S&P 600 looks good here. Like we mentioned before, we broke out from this previous all-time high, which was right here. Nice aggressive move to the upside, and then now currently we're coming back to retest that high. That is normal price action. That is perfectly normal. Even if we were to wick down and come into the 50 or the 20 and the 50, still perfectly normal price action. The only thing that can be concerning is if we came back into this red zone and completely lost our momentum. That means that it was basically a fake out, and that markets had other intentions other than to continue to go higher. But until we see that, this looks pretty bullish, just from a technical standpoint. Next thing I want to take a look at is our volatility index. So here, we'll just kind of focus right in here in the last week or so. you see that the volatility index spiked, which basically just shows overall volatility in the market, right? It means that it's swinging aggressively one way to the upside or the downside. Now, if we go back and look here, this is Tuesday. We aggressively moved to the downside, right? That had to do with tariff talk, mostly tariff talk, but just more headlines than actual technicals or actual market performance. So what you see here is the VIX spiked on Tuesday, right? Had to do with that, all the tariff talks, and then aggressively sold off on Wednesday. This is not a stabilized volatility index spike. It tells us it's more headline driven and not overall market driven. Next up, let's look at gold. So gold is just absolutely going parabolic, right? Gold has been up only basically since last year, even part of 2023. I think it was aggressively moving to the upside. I mean, if you just pull back here, I mean, that is an absolutely parabolic move since August 2025. I mean, even before then, obviously, it was still going pretty aggressive, but this is just an absolute huge move. I think this more has to do with the overall debt issue with the U.S. government and governments across the world. We know central banks are loading up on gold. It has more to do with the debasement trade, as far as the dollars losing buying power, inflation. These are assets that people buy into either during times of overall concern, economic deterioration, but I think it has more to do with political and geopolitical uncertainty. Typically, gold is a hedge against government actions and currency risk. Now, if we saw gold going parabolic while everything else sold off, then that's a major concern. But we're not seeing that. Equities and gold are both moving together, so it's not an overall market concern. I think it has more to do with just kind of what's going on around the world in general. Also, we're sitting in a situation where we were in quantitative tightening as far as the Federal Reserve is concerned. That ended the December 1st, which means that we're now neutral, which historically speaking means we're probably moving into an expansionary period where they're going to expand the balance sheet. Now, could that come in a month, 6 months, a year, 2 years? I don't know. Don't know. Typically, it doesn't take that long, but that could be why the gold and why silver is aggressively moving to the upside, because they're going to expand. The Fed's going to expand the balance sheet, which means they're going to print more money, which debases the currency. That's what I think this gold and silver trade has more to do with. Next up, we're going to look at the dollar index. So the dollar index, we haven't looked at the dollar index here, but it shows us, so they basically take a basket of currencies and compare it to the dollar, right? So this is essentially showing us how the dollar is performing in the open market. And what you see here is a pretty aggressive move to the downside from the dollar. Now, if we pull back a little bit, we have this long-standing trend. Let's see if we can get all this here. Can we get all this squeezed in here? Yeah. Anyway, what you see here is, it's essentially this long-standing uptrend that's been going on for a while, and the Dixie continues to respect it. But this is a nice, strong, aggressive move to the downside on the dollar. Typically, when the Dixie goes down, equities and gold go up, and that's exactly what we're seeing. Now, if this was going up, if it was aggressively going to the upside and it was in an uptrend, and also equities and gold were going up, then that would show a level of concern, right? That doesn't make as much sense. Does it happen? Of course it happens, but it's something to look out for. Now, if the dollar continues to aggressively move to the downside and breaks through this uptrend that's been going on for quite some time, that tends to be bullish for equities, not bullish for the dollar. What we want to be not holding dollars. We want to be getting into appreciating assets if that is the situation. If this continues to move to the downside, assets will continue to rise to the upside. Here we have, this is going to be our comparison for the QQQs, basically the NASDAQ and the S&P 500. And what you'll see here, and we've talked about this a few weeks in a row, is that we've seen the NASDAQ or the tech essentially underperforming for the last couple of months. And you're seeing that play out here right on this chart. So if it's going to the downside, that means that the NASDAQ is underperforming the S&P 500. What we see here is a downtrend, and we've got our trend line. Now we'll see here is that as soon as it tried to break this trend line, it wicked out and sellers cleared their positions. But with that said, if we saw this break this trend, that would suggest that tech is coming back. That would suggest that the Mag 7 is probably coming back, and that the overall market will continue to perform well. If the breadth stays, if the small caps, mid caps, and other large caps continue to get involved, and then you also have the tech sector and the Mag 7 starting to outperform again, then you've got a real rally on your hands. And from my perspective, that's basically suggesting that the markets are expecting quantitative easing sooner than later. They're expecting rates to continue to get cut. They're expecting for money to start entering the system via the Federal Reserve. And we might also start seeing that, I can't remember, $7 or $8 trillion that are sitting in money markets. That might start looking for a new home as well, which would likely go into more risk assets with higher upside. So that's what I'm watching closely right now. That's what these overall markets, that's what they're telling me. Now, could we have some sort of event that comes up that kind of reverses this trend and changes the overall dynamic? You bet. With the current political situation globally, not just in the U.S., not just domestically, all it takes is, one scuffle, one thing to go sideways, tariffs to change, or situations in Iran to shift. Like, there is certainly a lot of turmoil that exists in the overall geopolitical situation, which could shift things. But I want you to keep in mind that those, in some cases, tend to be good situations to start getting involved in assets, because those things can be used as smoke screens or used to put fear in the overall market when, in most instances, institutions, big whales, big buyers, they want to buy when there's fear in the market because they know that that's just temporary, right? We have to remember that as investors, that fear is only temporary. Mentally, you think that if it's going in one direction, it's going to keep going in that direction forever, when that is not the case. Fear is usually a good indicator to start getting into the overall markets. The last chart I wanted to take a look at is Bitcoin. So this is becoming my canary in the coal mine, and this is the only thing that is still putting a little concern in my overall thinking. Okay, so right now we've got S&P doing well. We've got S&P 600 doing well. We see the equally weighted S&P doing well, which tells us that breadth is returning to the market, that other equities are starting to get involved and are starting to carry the overall index as opposed to the mega caps, which is great. That's what we want to see. Bitcoin is, in my mind, one of the best indicators of risk and liquidity in the overall market. Now, when Bitcoin and cryptos in general are still underperforming, they are not picking up the way that the small caps are. It could simply be because small caps are going to move first. Russell 2000, S&P 600 tend to move before crypto does, before Bitcoin does. Not always, but certainly seems to go that situation. But if we don't start to see Bitcoin actually start trading with some of these other tech stocks and expanding the breadth in the overall market, This is a concern to me. If it can't start picking up, then that means that there's a liquidity issue in the overall markets, and that what we're seeing might not be as healthy as what we think. This is my current indicator. Until this actually starts picking up, then there's still a concern in the back of my mind that says why is the ultimate risk asset not moving when we've got risk returning to the markets? Okay, so this is what I'm looking at. If we're below the 20 and the 50, we're below our volume weighted moving averages, which aren't on the screen, but it certainly is below them. If it just rolls over and takes a dump from here, that's a concern. Okay, that's a concern that tells me that the overall markets aren't as healthy as they appear. Or Bitcoin is crap, which I don't think that that's the case. But if we see it kind of defend this area, and we get our momentum waves to kind of turn up and get going that way, and Bitcoin starts getting involved and crypto starts getting involved in the overall market, it tells me liquidity is returning. Markets are relatively healthy, even though the overall backdrop might look not ideal. But this is the ultimate last indicator. If Bitcoin gets involved, for me, it's game on. So last week was a really good example of why you don't trade headlines. Okay, you have to understand what's going on from a technical perspective. Don't just trade headlines. If you trade headlines, you're going to get wiped out. Like the upcoming week is looking lighter on major economic data, which means headlines and sentiment can have outsized impact. Okay, so keep an eye on that. We currently have tariff talks again. This one's related to Canada. Going into next week, I am expecting some volatility just with what's going on globally and domestically in the US. There's certainly issues that are ongoing. There's things that could pop up that will create spikes in volatility, but keep your head on. Don't let headlines dictate how you look at markets, and look at overall structure. Are we still healthy? If we still look healthy, if we're still in an uptrend, that means that the market is doing fine. Chop will happen, volatility will happen, but it's not an overall negative indicator on what we're looking at. Structure always wins. Stay calm. Markets didn't break this week, even though headlines might have had you thinking it did. It's quietly demonstrating how strong the overall market is. That's all I had for you. Hope you enjoyed. Take care.